everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Robb, how you doing today?
I'm doing great, Gary. Excited to talk earnings and inflation issue. I think those are Gary Brode's two favorite things in the world.
Definitely. Yeah, it's always so much fun to spend, months and months working on a company, and then, just in 5 minutes after the close, a press release comes out and stocks will start moving, and it's that excitement of what's going to happen next. Sort of
Uh,
sort of our version of a horror movie.
yeah, there you go. Sounds great. That's why you do the job for us, right, Gary?
Exactly. Super fun.
All right. Well, this week, Gary, we're talking DKI portfolio company Coursera and their earning announcements. We've got Las Vegas Sands as well, reported last week. We'll talk about the Magnificent Seven. They make another appearance as we've been talking over the last couple of weeks. GDP, PCE. Gary, locked and loaded, ready to go.
Let's go.
All right. Thing number one, Gary, on this week's edition of the Five Things. Coursera, we're talking ticker COUR, enrolls 2 million in AI courses. Market is thrilled.
All right, Rob. So Coursera has been a tough pick around here. The company has suffered from two things. One, while it's had nothing but positive growth, in fairness, that growth rate has slowed. And at times the company has given some not so terrific guidance. They tend to beat guidance, but there's been some negative sentiment around that slowing growth rate. The other thing that's happened is competitor to you, which has a horrendous business model, which is different from Coursera's. They've handled their business so poorly that last week the company declared bankruptcy. And then there's non-competitor Chegg, which is really a tutoring slash cheating site. And they've had horrendous results. Again, it's a different business, but every time these companies announce bad results, it takes down Coursera stock. So last week, Coursera reported second quarter earnings. Expectations were pretty low for the company. They came in and beat it. They beat the top line by $6 million. That got people excited. More importantly, a lot of people have incorrectly been saying that AI is a threat to Coursera's business, that basically people weren't going to take classes anymore. They were just going to use AI to do everything. No one needs to learn anything. We might as well cancel school for everybody. I always thought that was a bad take, especially given the fact that Coursera was teaching classes. They were hosting classes to teach people how to use AI. I think there are a lot of people who want to learn that. Well, last week we finally got the proof. Um, Coursera had a whole bunch of new AI related courses. These were not courses created by AI. They were courses created to help people learn how to use it. They had 2 million enrollments in that. So what happened was the company beat and the stock closed the next day up almost 45%. I'd say it was a pretty good day.
Yeah, it was a great day. And Gary, I know you and I had talked about this, I think a few months ago, right? And it was almost like we were a little ahead of the curve, got caught in the wash a little bit with Coursera. But obviously I told a lot of people, hey, still as excited as ever. My question is actually, and I don't even know if you have these numbers because it wasn't in the takeaway. Do you know what the distribution of growth is based on from a geographical standpoint? My curiosity, right, and where I've always seen Coursera as a huge value is with the globalized workforce, right, and especially in areas like IT, staffing, digital marketing, where we play in the space, right? I see it as a huge game changer for that market to where there's a lot of overseas talent that can be leveraged.
Yeah, Rob, I think there are three areas where we would expect to see some really good growth from Coursera. One is in emerging markets, places like Brazil or India, where you have large numbers of young people who are driven to work really hard and get an education and get good jobs, but who don't have the ability to take on ridiculous amounts of debt or pay huge amounts to either travel to the US or pay full prices. Those are markets where the ability to offer courses or certificates or degrees for a few $1,000s, that works in that population, that group of people, and they get their degrees done or certificates done really quickly. and then end up with better jobs. It works really well for them. The other two places where I think we can expect to see some really good growth from Coursera is in corporations. And so somebody today had suggested to me on Twitter or X, they tagged me with, I thought, some really interesting analysis. And they were talking about, hey, wait a minute, why wouldn't Microsoft or Google just host these courses themselves? And the truth is, they don't want to do that. They partner with Coursera. Coursera hosts these courses, they advertise them, they get them in front of more people. And then what happens is people will, instead of paying $100 or $200 or $300,000 for a university degree, they'll take these courses, this suite of courses that have been put together by companies like Microsoft or Google. And then when they complete them, Coursera will say, okay, great, we certify that you've taken these courses, and then they can go apply for jobs at these tech companies and they will have demonstrated we've taken the relevant coursework, we know what we need to know to hit the ground running, and that's working really well. The final area where I think we could see some growth are in government partnerships. Some of the local and state governments have figured out they may have a high unemployment rate, and paying people to take these courses so that they can get employed is actually better than paying them to be on welfare for longer or on unemployment for longer. And that's good for everybody, right? If you are a taxpayer, you'd much prefer that people not be on public assistance and get jobs. And if you're somebody who's on public assistance and the government is saying, hey, we're going to offer you courses and training and help you get a job, that's a much better life than being on welfare or being on unemployment for years and years. So these are kind of those win-win-win programs where everybody ends up better off. I think you get better outcomes for everybody, especially the people who can start to build a career instead of staying on public assistance. So I think those are all areas for growth for Coursera, and those are the kinds of things that we feel good about supporting. This is one of those companies where you feel like, hey, wait a minute, they're actually doing some really good things here.
Great stuff, Gary, and excellent things coming out of the Coursera camp. We'll be sure to keep you in tune with any new developments over the rest of this year and into next. Gary, thing number 2, another fun one. Gary, this is you speaking here.
Yeah.
I disagree with the market on Las Vegas Sands earnings. Gary Brode literally drawing a line in the sand.
Yeah, so Sands, the stock has traded terribly in recent months. I think that's due to two things. One is there are some legitimate concerns about the Chinese economy, and let's take these one at a time, right? So a lot of people are saying, hey, China's experiencing all kinds of problems, and they are. Just a week ago, we were talking about China putting capital into their banking sector. You don't do that when things are good, and China's banking sector is highly leveraged to their property market, which is that for the Chinese people, that's like their stock market. That's where people store their wealth there. So, what people are saying is, wait a minute, this Chinese economy is in bad shape. That's going to be bad for Las Vegas Sands, except it hasn't been. By and large, the mass and premium mass people where Sands excels and where they have leading market share, they've come back, and they've come back with pent-up bankroll. And so there's really no evidence that weakness in the Chinese economy is hurting these results in Macau. So that's part of what's going on. The other thing is there's been concern about potentially weaker results at a couple of properties, in particular the Londoner in Macau, due to renovations. And my response is, okay, so what? Yeah. The fact is that casinos tend to take a lot of hard use. People are there to party and have a good time. And they also, in addition to taking a lot of hard use, need to be luxurious, right? You just can't have like a Las Vegas Sands hotel looking like a Super 8 motel here in the US. They need to be in good shape. And so as a result, these properties are regularly renovated and improved. And that's what we're seeing. And right now, somewhere in the neighborhood of 1,500 rooms are out of order. When they're done in the next 4 to 6 months, those rooms will come back in. They're looking at higher than average room rates, a greater number of suites. This is one of those things where, yeah, the rooms are offline for a couple of quarters, but when they come back, I think everything's fine. And so, that's what we're seeing. On the other side, They have the Marina Bay Sands in Singapore. That property is producing record results. And by record results, I mean they're crushing the pre-COVID numbers. This property has never performed that well, and they are currently Sands is currently in the process of building a fourth tower there, concert venue, more casino floor space. They're building out everything. So, I think this is a company where people are looking at one thing that's not happening and another thing that's temporary. When I look at the actual results and the pro forma results for when they're done with these renovations again in the next 2 quarters, to me, things look pretty good.
Gary, it seems like one of those cases where the market is obviously pessimistic, but they're just either looking at the wrong things, right? Or they're looking at it through a lens that doesn't give them the full picture and understanding that you might if you are boots on the ground.
I mean, that's the case, and like that's the struggle, right? I mean, Rob, the place where you really make money in the market is when you disagree with the market and you understand why. And I think that's the case here, but everybody involved isn't dumb. The market isn't always wrong. There's certainly the possibility that I could be the sucker here. I don't think that's the case. This is the company that I've covered for a decade. I think I understand their operations and what they're doing to come back. Again, Singapore record results. If you back out the Londoner, which is the one under construction, it actually looks like the other properties they have in Macau are performing well and continuing to grow and improve. So, that's what I'm seeing, but that's the struggle. The way you make money in this business is by seeing things differently than other people. And, hopefully we're the ones who are right most of the time, but there are no guarantees. As I've said before, I had a sure thing in the stock market once, but I lost money in it.
Yeah, there you go. Fingers crossed. Moving to thing number 3, Gary, we're circling back to the Magnificent Seven. Thing number 3 on this week's edition of the 5 Things, the Magnificent Seven's magnificent tumble.
Yeah,
Always making it tough on you.
I'm sorry, right? Magnificent Seven, right? We'll lock that down. So as we talked about last week, there's a group of 7 tech stocks that have led the market. These are mega cap stocks, and they did really well. The end of 22, all of last year, and the first half of this year, they've done really well. The last couple of weeks, those stocks have performed really poorly. In particular, the market leader, Nvidia, which is the company that has just rocketed the whole market, that stock in the 2 weeks closing last Thursday was down more than 15%. Same thing from Tesla. So we're seeing a variety of things here. Alphabet, or as we know it, Google, they missed estimates for YouTube's advertising revenue. People were disappointed on that. That caused the stock price to fall. Tesla reported lower than expected earnings and a big decline in profits. A big part of that was a decline in registrations, particularly in California, which the company is in the process of exiting. Basically what we're seeing is these stocks are priced for perfection. They've just gone up an enormous amount. And so any results that they announce that are something less than perfect have been causing, 10, 15% declines. And when you have something like 25 or 30% of the market cap of your index tied up in 7 stocks and a couple of them report bad earnings, that will take down the whole market. And that's what we saw, again, last week. That was through Thursday. Some things started to come back on Friday.
I know, Gary, we have Nvidia earnings this week, I believe. What are you looking for in that earning report?
You know what? That's a great question. I haven't taken a look at the benchmarks of what people are looking for from the company, but basically, the reason that stock has been so highly valued is because the revenue growth they've had has been incredible, and their guidance, they keep raising it an enormous amount. Just a reminder, if you've got a company with a market cap of around $3 trillion, you need to beat earnings, right? You need to have huge revenue numbers. You need to take up guidance. So I think that's what the market's going to look for from Nvidia. And, the fact that the stock is down 15% before reporting earnings tells you people are concerned about that. I don't think there's anything wrong at Nvidia. I don't think there's anything wrong with the company, with their products at the company. I just think it's a case where there's a lot of excitement about results and people are concerned that, they may not make very high expectations. One company that's not part of the Magnificent Seven, but had some really bad results was Verizon, another tech company, a communications company. They lost over 500,000 pay-as-you-go plans. And the reason for that is it was the ending of stimulus funds from the Affordable Connectivity Program, which was assisting certain households in paying for their cell
Huh.
phone bills, and that expired. And Rob, that's something we've talked a lot about on this channel and on this program, which is government stimulus is largely holding up the economy. And we're seeing just weaker and weaker results from the private market economy, the productive part of the economy. And so, where you see a government stimulus program ending and all of a sudden, 600,000 people are canceling their cell phone programs. And as a result, Verizon misses earnings and their stock gets hammered. This is the kind of stuff we're talking about. The government can't be funding everything all the time, despite the fact that they're trying to. So, these tech earnings actually came back around to something that's been a regular theme around here, which is public market spending pushing out private market investment.
With Nvidia, Gary, if we do see a big GPU count, which we're going to see big regardless, right? But if trends continue, it's going to be more and more. Is there anywhere you're looking that could be a part of that positive trend for GPU production?
Yeah, energy. That has been a huge part of this. And one of the things that's fascinated me is people are very excited about the future for AI. Okay, fair enough. I've seen it in action. I understand why people are excited. Um, it can do some really amazing things. And, the reason Nvidia ended up with a $3 trillion market cap before this, recent drawdown, is because people were buying tens and hundreds of thousands of these high-end GPUs. Well, here's the key thing. These GPUs use a multiple of the amount of energy and power that regular servers and data centers used just a few years ago. These are very energy intensive applications and hardware. And so, I read somewhere that the expectation for AI is it's going to take up somewhere in the neighborhood of 10 to 15% of our current power supply. Well, Rob, we don't have that much spare capacity. And so we're going to need to start building out capacity. I don't think anybody is going to start approving large numbers of new coal plants or natural gas plants. To me, the obvious thing is nuclear. And so, my question to everyone is, do you own enough power generation and uranium in your portfolio? If you don't, deepknowledgeinvesting.com, click the subscription button. We are loaded up and prepared for this. So, there are multiple ways to play this AI situation, but I don't see how we can get this this next stage of information age benefit without building out a ton of capacity. And unless people want to start, building out more carbon related energy plants, it's going to be nuclear, and that means uranium. So, this is a place where we've done a lot of work. It's a place where we've been profitably invested for more than 2 years. If you want help on that, reach out. We're here for you.
Yeah, it's going to be interesting just with we're seeing a lot of it, right? With the AI piece, just the rate, the acceleration of that information, the amount of data that's being passed back and forth from a network perspective, right? Yeah, it's very interesting. And, I don't know what the whole CrowdStrike piece was, but that's obviously an interesting piece too, that when things do go wrong, so it has to be continued infrastructure that you have to invest in for where AI is taking the tech space. So interesting stuff, Gary. Thing number 4, we're checking in with GDP, high GDP and rate cuts with a question mark there at the end.
Yeah. So second quarter GDP came in at 2.8%. That's a solid number on both an absolute and a relative basis. 2.8% growth, that's not bad. The estimate was for 2% growth, so 2.8% crushes it. So do we have a healthy economy? Is everything okay? What do you think, Rob?
I don't think so, and I think what we have is a bifurcated economy.
There
If
you
I've been
go.
picking up on the keywords and
Yeah,
buzzwords
you
here,
you you nailed it. Um, basically,
don't catch me off guard like that ever again.
sorry. Yeah, it was a trap. It was a trap. Don't fall for the trap, Rob. Um, look, if you're listening to this video and you're struggling at home, we understand that. And there are a lot of people struggling right now. I don't actually think the economy is in good shape, the private market economy. And so if you're having a hard time, I believe you. We get that. And that's what we're seeing as well. The reason we got this good GDP print is because of massive amounts of government stimulus spending. The government is overspending by, $2-3 trillion a year. That's just the on balance sheet numbers. If you include off balance sheet for programs like Social Security, Medicare, Medicaid, Obamacare, all of these pensions, all of these benefit programs where we're incurring liabilities but not necessarily paying them out now, add another, 6-7 trillion dollars to that. So we're overspending right now by somewhere in the neighborhood of like $8-10 trillion a year. Of that, you're looking at maybe $3 trillion a year of cash. Um, that is a massive amount of government stimulus spending, and that will affect GDP, whether it creates value or not. And so, think about this for a minute. If the government were to say, take $1 trillion and fix our roads, well, that could be productive. They were going to take $1 trillion and, build bridges, repair bridges, improve our transportation infrastructure. These would all be things where we could look at that and say, okay, yeah, I get it. I get how we're investing. But that's not what's happening. The money that's being spent is pushing out private market investment. It has a negative return. It's all on pulling consumption forward. Rob, think about it this way. Try to imagine if you're making a certain amount of money and you decide, yeah, I'm going to work less. I'm going to earn less money, but start spending a lot on my credit card, and you start to accrue all of this debt. Is your household economy in good shape? Absolutely not. But that's what the country is doing. And what people are starting to realize is that the government has a balance sheet, just like each of our households do. And that's what's happening. And so, what I'm seeing is that 2.8% print. That's great on an absolute basis. It's fantastic on a relative basis, relative to expectations. But it doesn't mean that we have a healthy economy. It just means the government is printing huge amounts of fiat, huge amounts of dollars, and pulling forward consumption, and that's not a great economy. And so if you're struggling at home and saying, wait a minute, how am I being told the economy is in good shape? That's how the economy is not in good shape, is just government spending pushing out the things that you would be doing to earn a living.
Yeah, great message there that everybody needs to hear. Gary, we have September rate cuts coming up. The market has kind of baked in a 100% probability. What line would I be getting from Gary Brode Casino if you were to set that line for me?
Well, it's easy to take the under on 100%. But look, let's be clear on this, Rob. On one hand, the market has been wrong for over 2 years. People started calling for rate cuts around May or June of 2022, which was ridiculous. I've spent the last 3 years saying, it's going to be higher for longer. We started talking about inflation in November of 21. And when people were calling for rate cuts in mid 22, I flat out said that's ridiculous. But we've now gotten to the point where the entire market, and the market hasn't been predictive on this. The market has been wrong on all of these, but now we're at the point where some really smart people who I respect, like Michael Shedlock, who's an economist, he's on the DKI Board of Advisors. He thinks there's 100% probability of a September rate cut, and he thinks maybe not 25 basis points, that the Fed could go 50 basis points. Mish is somebody I respect, and there are some other people as well. Danielle DiMartino Booth, who's somebody I respect on the macro side. She thinks we're already in recession, which I agree with on the private market economy. So at this point, there are a lot of really smart people saying we're heading for rate cuts. At this point, it's possible, but it's pretty easy to take the under when people are saying, 100% probability because you can't take the over.
Great stuff. Gary, thing number 5, we're going to PCE, personal consumption expenditures. The PCE comes in slightly higher than expected.
Yeah. So, as we've talked about on this program before, there are lots of measures of inflation. Now, they're all manipulated, but the PCE, which stands for personal consumption expenditures, is the preferred inflation metric that's used by the Federal Reserve. And the reason is that most closely represents what's happening to people's actual spending. Actual spending. As opposed to anything theoretical, like the CPI, which has, sort of a basket. Um, in this case, the annual increase of 2.5% was down just 0.1% from last month, but it was above expectations for 2.4%. The core PCE, that's the PCE excluding food and energy, was flat at 2.6%. That was also above expectations of 2.5%. And we saw a continued trend where income was up, but up by less than inflation. So yet again, people are taking in more income, but they're spending even more. Wage increases exist, but they are not keeping up with inflation. And so, that's an issue. The other thing, Rob, and I'm going to harp on this till the end of time. I don't care how many times I have to say it. But this report also said food prices are up 1.4% versus last year. Do you believe that number?
There's no way they're only
Right.
up. Yeah.
If anybody listening to this, if your grocery bill is up only 1% this year, put it in the comments. You would literally be the first person to tell me, no, my grocery bill is about the same as last year. I don't know anybody experiencing that. So, when we talk about these government metrics being adjusted, changed, adulterated, this is what we're talking about. You end up with some aspect of it that's just ridiculous. That said, people were saying, hey, we've got this great PCE. It's come down a little bit. It didn't come down. So the Fed should lower rates. Well, 2.5% is not the 2% they're aiming for. So, I'm not sure where that's coming from, but people are very excited to talk about rate cuts and have been for over 2 years.
I think the big takeaway that I have here is a common theme that we've had on this show, higher for longer, but we have higher for longer parentheses, probably exclamation mark. So
Yeah.
maybe moving a little bit off that line, Gary.
Yeah, and look, let's be clear. It's okay to not be 100% certain on things. You know, YouTube or Twitter, X now, is full of people who like to make bombastic predictions. But the market doesn't really work that way, and you have to look at things in terms of probabilities. So, in fairness, I have spent the last 2.5 years screaming higher for longer. We're not getting rate cuts. It's not coming. And, I thought it was ridiculous when people were calling for rate cuts 2 years ago. I mean, Rob, that just wasn't going to happen. And then I was really comfortable saying, absolutely not, you're all wrong. Now we're in a situation where, the private market economy is struggling. Powell and the Fed have been talking about cutting rates. They clearly want to. As we just talked about in the last segment, people I respect, like Mish, are saying, absolutely, this is happening. I'm about 50-50 on it, which I realize is a little wishy-washy. But, let's talk about the reasons. The people who are saying 100% we're getting rate cuts are looking at, one, market expectations, which have been wrong, and two, a private market economy that's tipping into recession. I agree with them on that. If I want to make the case that don't be so certain about a September Fed rate cut, uh, here's what I would point to. One, continued inflation still well above 2%. You got a CPI around 3%, the PCE around 2.5%. Two, aggregate GDP numbers that are still strong due to massive government stimulus spending. So, if we'd gotten a 1% GDP number, okay, fine. I could see that. That's kind of anemic at 2.8%. It's tough to cut on that. Three, as we said, market participants have been predicting rate cuts for over 2 years. So looking at market expectations, that has not been predicted. The market has been wrong for more than 2 years on this. And then four, like I said, if the market's predicting 100% probability of something, it's pretty easy to take the under. You can't take the over. So I understand why people are saying rate cuts are coming. Eventually they will come. Do I think it's a big deal? There's some people who are saying we're going to get a 25 basis point cut in September and nothing. Rob, I've been on this show earlier saying I think we'll get 125 basis point rate cut in December. Yeah. Are we really disagreeing by that much? If people are saying 25 to 50 basis point cuts, they're saying September, I'm saying December. I don't know that it matters that much. I'm just less certain that we'll get a September cut than some other people are for the reasons I mentioned.
Sounds good. Thanks, Gary, for clarifying that. And moving to thing number 6, talking intern Alex. Intern Alex goes to the Bitcoin conference, meets people.
Yeah.
Great headline.
Yeah, I wrote that, Saturday morning. Unfortunately, that was post coffee. That one's a little embarrassing. But
I like it.
I think it's a great thing. Here's our intern Alex, who he's still in university and he flew to the US for the first time and was in Tennessee for the Bitcoin conference and was warmly received. And I went to the Bitcoin conference a couple of years ago. I thought the crowd there was fantastic. These places have an incredible energy. It's really easy to meet these, we'll call them Bitcoin celebrities. But he was there with Peruvian Bull, who he had interned for last year. Peruvian Bull is somebody I respect a lot on the macro side. He's also, a big Bitcoiner. He also met Dylan LeClaire, Alan Farrington, and had a chance to take a picture with Da Vinci Jeremy, who, to Da Vinci's credit, there is a YouTube video of him publicly suggesting people put at least a small amount of their assets in Bitcoin. That video is dated 11 years ago. Good for you, Da Vinci, right? 11 years ago, going out in public and saying, everybody just buy a little bit of Bitcoin. You'll be happy you did. Good for him for having that kind of foresight. I think it's fantastic that, Alex had this kind of exposure and got to go meet people. All of that's terrific. Also, I had a chance to meet him in person, because he works in the UK or lives in the UK. We hadn't had a chance to meet, but there was a fire at JFK. He got stranded and, living an hour from that airport, I called him. I'm like, well, don't be stranded in the airport overnight. Just come here. He came and we had a beer together and he had a warm bed in a room for the night, which was a lot better than sitting in the airport.
Good stuff. Gary, on the takeaway here, I'll kind of let you take it away. I think just as a call out to those that you've worked with, interns in the past, I know it's been great working with Andrew and Alex alongside those guys. Always been super impressed with anybody that comes out of DKI, and I know they're doing a lot of cool things too in the finance space after being an intern with DKI.
Yeah, I'm really proud of them. I think Alex is our 9th intern. So far we have a 100% success rate. Every single one of these interns has, when they've graduated with a real job in finance. In some ways, what they're doing is easier now than when I was coming up. There are videos, presentations, a whole FinTwit or FinX community, incredible access to the detailed thinking of top money managers and economists. A lot of the knowledge that they have was very hard to get when I was coming up. In many ways, you had to work for a hedge fund to figure out how these things worked. And the only way you could get in was to have worked for one. It was like this really weird, difficult circular thing. Now these kids have access to the thinking of all kinds of top economists, top money managers, but to their credit, they have all in their spare time invested hundreds and hundreds of hours of figuring out how the markets work, how to value stocks, how the economy works. They are just miles beyond where I was when I was at their stage. It's great to see them putting this kind of effort in. A bunch of them have wanted to have internships while they were in school. They're doing this in their free time. They are driven. They have no sense of entitlement. Forget, people talk about younger generations being fragile. these guys, not only do they not shy away from criticism or correction, they ask for it because they want to get better. I'm so proud of every one of them. And it was great to see Alex go to the Bitcoin conference and connect with and learn from other Bitcoiners. I wouldn't be surprised if he became a speaker there one day. And, not just them, hat tip to Peruvian Bull, Dylan LeClaire, Alan Farrington, Da Vinci for welcoming Alex and for saying, hey, we want to train and educate this next generation of Bitcoiners. It's a very welcoming community. Also, one of the things that we're going to be talking about next week, but here's the obvious preview. A day after we finalized this week's 5 things, President Trump got on stage at the Bitcoin conference and said we should have a Bitcoin strategic reserve. The U.S. Treasury should own Bitcoin. I think that's fantastic. My home state of Michigan just announced it has a few $1 million of Bitcoin in its pension funds. I think we're going to start seeing more and more announcements like this. And truthfully, Rob, if I were the government and I could print unlimited amounts of worthless fiat, that's what I would do. I would print fiat and buy huge amounts of Bitcoin and gold and silver, right? I would have reserves in all of these things. I'd replenish the SPR, the Strategic Petroleum Reserve. If we can print trillions of dollars with no consequences, we might as well print that and buy lots of hard assets. So, I think this was a smart move by President Trump to understand the value of hard assets, to understand that the dollar isn't worth so much. Now, for detractors, I agree with you. One of the reasons the dollar isn't worth so much is because of massive overspending by both political parties, including Donald Trump when he was president. So, as much as I'm complimenting him on this, the truth is politicians of both parties, including President Trump, have been the reason that the dollar is declining in value. This overspending is a huge problem. But, our response to people saying sovereign nations should hold Bitcoin and to seeing, state pension funds owning Bitcoin is HODL, right? Hold on to your Bitcoin. If you don't own it, maybe buy a little bit. You can't go back in time and take Da Vinci's advice from 11 years ago, but I'm telling you the same thing right now. So
Listen now. Yeah, that's
right.
right.
Yeah. 11 years from now, I would love for someone to look at this video and say, holy crap, we could have bought this at, 67,000,
The
which is
old,
where,
I believe it's a Chinese proverb, I think. Best day to plant a tree was yesterday. Second best day is today.
yeah. And that's absolutely the right way to think about this. Da Vinci was right 11 years ago. I believe 11 years from now, I'm going to be proven right. And, regardless of where you stand on the political spectrum, Bitcoin is for everybody. It's for Democrats, for Republicans, for libertarians, for independents, for people who are so fed up with the political process that you don't want to vote. That's respectable too. I know people say if you don't vote, you have no right to complain. That's nonsense. Deciding I don't want to participate in this is a completely valid position. And whoever you are, Bitcoin is for you. You're welcome in that tent, regardless of where you stand on your politics, regardless of where you stand on President Trump. You should still take a look at Bitcoin and realize that you're welcome to be part of what's going on. And so just like Alex was warmly welcomed by the people in that community, and just like Da Vinci encouraged people to own Bitcoin 11 years ago. I'm telling you the same thing now. You're all welcome. You're all welcome to own Bitcoin. And I think as more governments own it, you're going to have a scarcity problem. So buy it now before it's harder to buy.
That concludes this week's version of the 5 things. Intern Alex got us in for a bonus 6th thing this week. As always, we'd love if you could like, share, comment, send it to a friend. Any of these videos that you come upon, any of that support helps us tremendously, helps to provide great research, insights, bring on great new talent like Alex and Andrew as well. So any of the support would be great, as well as considering a premium subscription. For $100 a month, You're going to have access to all current recommendations, access to exclusive webinars, and a whole host more from Deep Knowledge Investing. But also, if it is just a free subscription, signing up on our website to receive email that keeps you up to date on things that are happening. Gary, any closing thoughts?
Yeah, one for everyone watching this, thanks so much. We value your time. We appreciate you spending this time with us. I also want to offer a special thank you to our viewers for the great engagement. Last week, we had a couple of videos that got a little more attention than usual. And, some of you just pinged in to comment, terrific. I agree with you. Really liked it. Thank you so much. Some of you made some really interesting points and told me about your view on things, and it turned into some really good conversations. Great to have that interaction. And, for those of you who disagree with me, thanks so much for posting that and explaining why and giving me your point of view. Love to have that interaction, that conversation. So for everybody who was commenting last week, thanks so much. Great to hear from you, and thanks for being part of this program. We really appreciate you.
Thanks, everyone.